Trump's Amazon tariffs create massive opportunity for Canada. Amazon is quietly shifting its supply chain strategy, and Canada is the biggest beneficiary. Trump's expanded tariffs on Chinese goods have forced the retail giant to rethink its reliance on U.S. imports. And now our northern logistics hubs are looking mighty attractive. The reason is simple. Amazon is rerouting billions in trade away from costly U.S. ports, canceling deals with Chinese suppliers, and searching for safer, cheaper routes. This isn't just about shipping costs. Entire sectors from manufacturing to warehousing are suddenly pivoting toward Canadian infrastructure. But Ottawa needs to act fast to upgrade ports and customs systems or risk missing out. Across Canada, a logistics boom is underway. Ports in Vancouver and Montreal are seeing a surge in container traffic as global companies reroute shipments to avoid U.S. tariffs. This isn't a subtle shift. It's a dramatic rerouting of trade flows. And the evidence is everywhere. Warehouses in Toronto and other major cities are filling up fast, and companies are scrambling to secure space for new distribution centers. According to Amazon's own reports, 5 new logistics centers are opening in Burnaby, Calgary, Windsor, Ottawa, and Richmond Hill, boosting capacity by roughly 28% since April. By the end of this year, Amazon plans to hire 9,000 new staff across the country to keep up with demand. The reason for this boom is simple. Importing Chinese goods through Vancouver, then moving them by rail or truck into the United States under USMCA rules, can undercut direct U.S. imports by double-digit percentages. U.S. tariffs are driving up costs at American ports while Canada's trade policies and geographic advantage offer a more stable and cost-effective route. That's why record volumes of goods are flowing through Canadian customs, with brokers reporting a sharp uptick in Amazon-related shipments. The backlog at major ports is growing, but Canadian infrastructure is absorbing the pressure for now. Canada's ports have spare capacity that U.S. West Coast terminals just can't match. While ships at Los Angeles and Long Beach face long waits, Vancouver and Montreal are moving containers through more quickly. Recent expansions like the Centrum project in Vancouver and new terminals in Montreal are paying off, giving Canada a clear edge as global supply chains look for reliability. This isn't a temporary fix. Companies are locking in multi-year leases on warehouse space and investing in new facilities. Amazon's rapid expansion is just the start. The country's rail networks, historically focused on moving oil, are now shifting capacity toward consumer goods. CP and CN have invested billions in upgrades to handle the surge, and the payoff is starting to show. U.S. protectionism may have created the opening, but Canada's stable trade agreements are what's locking in the gains. While Washington threatens to rewrite the rules, Ottawa is signing new deals with partners in Asia and beyond. The result is a logistics sector that's suddenly at the center of global trade. And the impact doesn't stop at ports and warehouses. The real test is whether Canada's manufacturing sector can capitalize on this moment, or if these new supply chains will just pass through on their way to American shelves. Manufacturing in Canada has not seen an opening like this in decades. As tariffs hit Chinese imports with duties as high as 145%, U.S. buyers are suddenly looking north for alternatives. Factories in Kitchener are switching over to produce Bluetooth speakers and smart home devices, products that until now came almost exclusively from Shenzhen. In Quebec, textile mills that sat idle for years are being brought back online to supply home goods and apparel. This shift isn't about nostalgia for old industries. It's about basic economics. When a Chinese-made microwave faces a 145% duty in the U.S., its price can more than double overnight. While a Canadian-made equivalent, facing only a 5% duty, becomes the obvious choice for American retailers. These are not hypothetical numbers, they're estimates based on the new tariff rates. The broader story is a surge in interest from U.S. brands. Retailers that once depended on Chinese suppliers are now exploring Canadian factories to fill the gaps left by disrupted supply chains. This sudden demand is pushing Canadian manufacturing into a position it hasn't held since before the 20-year decline that began after NAFTA. The opportunity is real, but it comes with challenges. Manufacturers warn that finding enough skilled labor will take time. Training programs are ramping up, but the pipeline of new workers isn't keeping pace with the spike in orders. This labor crunch is especially acute in electronics and textiles where technical skills are essential. Costs are another factor. The price of aluminum sheet has jumped since tariffs began, in part because Canada faces its own duties on metal shipped to the United States. Plastic resins are more expensive too. As Asian suppliers pass along higher costs from lost American business, Manufacturers say these input costs could erase much of Canada's pricing advantage if they keep rising. Smaller operations in particular are really struggling to secure the raw materials and working capital needed to scale up. Some are calling for Ottawa to guarantee short-term loans through the Business Development Bank to help bridge the gap. Trade rules are shaping the response. Under USMCA, any product with at least 55% North American content qualifies for duty-free access to the US. Canadian factories are using this to their advantage by assembling goods with a mix of local labor and imported components. For example, a Vancouver company now builds security cameras with 60% Canadian labor and 40% Chinese parts, sidestepping the tariffs that would apply to fully imported products. Quebec is leading the way with documented provincial investment. Last year, the government put $380 million into reviving the textile sector, and the results are already visible. 14 mills have reopened, creating 3,200 new jobs. One Montreal factory secured a $90 million contract to supply hotel linens that used to come from China. These are concrete gains, but the window may close quickly. Vietnam's exports to the U.S. are up sharply as companies diversify their sourcing, and Mexico's lower wages keep it competitive. Canadian producers will need to invest in automation and scale to hold on to these new markets. The real wild card in all of this is the consumer. Tariffs have pushed up prices on everything from clothing to electronics, and Canadian shoppers are noticing a rare shift. Amazon prices are dropping north of the border even as U.S. prices climb. This isn't a permanent discount. It's a temporary side effect of Amazon rerouting inventory through Canadian ports to dodge tariffs, creating short-lived deals on smart home devices, kitchenware, and more. When you see a $200 item in the US selling for 189 Canadian dollars in Canada, that's not a new normal. It's an estimate of how much tariffs can distort the marketplace before supply and demand catch up. Retailers are, well, they're sounding the alarm about the impact. The National Retail Federation has even called these tariffs a tax on consumers, and, the price hikes are already making a dent in household budgets. Projections are showing that baby car seats could jump by $100 in the United States, while basic electronics might go up by 15%. Oh, and footwear and apparel from Asia are climbing too. For now, Canadians are, sort of, shielded from the worst of it. Amazon has told investors that the company is absorbing tariff costs to keep prices stable. But they did admit this strategy can't last forever. Eventually, those costs will appear in the price tag, and the gap between Canadian and U.S. prices will narrow. There's another twist in the tale. Amazon's logistics algorithms are now routing some U.S. orders through Canadian fulfillment centers whenever it saves money. American consumers are starting to notice these price differences and are exploring Canadian options, especially in categories where the savings are significant. For Canadian shoppers, the current oversupply in local warehouses means temporary bargains. But, that window is closing fast. As inventory clears and demand rises, prices will adjust. Canadian manufacturers, meanwhile, are seeing both opportunity and risk. Their goods compete with imports that entered tariff-free, and some are already losing contracts when the cost advantage disappears. Market volatility is the new normal. Analysts are tracking dozens of product categories where Canadian prices undercut U.S. listings, but nobody expects this to last. The price advantage could vanish as soon as global supply chains adapt, or if tariffs are relaxed. At the same time, Canada's single window initiative meant to modernize customs processing is behind schedule, causing delays and adding to the uncertainty for retailers. The government's response has been slow, and the fallout from these shifting supply chains is piling up. If Ottawa doesn't adapt its trade and logistics policies soon, these consumer gains could evaporate just as quickly as they appeared. Canada's trade policy is at a crossroads, and the next 18 months will decide if we can step up as the world's go-to supply chain alternative. The U.S. tariffs threw global logistics into chaos, forcing companies like Amazon to cancel $400 million in direct shipments from China within months of the latest tariff wave. That disruption gave Canada a rare opening. But it's not enough to just be the next stop on the map. Ottawa needs to act, and fast, or watch this moment slip away to faster-moving rivals. First, port expansions can't wait years. Vancouver's Centre project took 4 years, but that timeline is out of date. Montreal's Contra terminal is still years from completion, while demand is already surging. The government should fast-track digital manifest clearance and set up temporary container yards to handle the overflow. Canada's border technology lags behind global leaders, and when volumes spike, processing slows to a crawl. The Canada Border Services Agency is still rolling out its single window initiative, but it won't be ready until late 2025. That's too late for companies rerouting goods right now. In places like Rotterdam, AI-driven custom systems move tens of thousands of containers a day, with near-perfect accuracy. Canada's manual checks just aren't built for this volume. Trade corridors need urgent attention. While Mexico's ports are seeing a surge in Asian imports, Canada hasn't moved quickly enough to lock in direct shipping routes from major Asian ports like Hong Kong or Shanghai to Prince Rupert or Vancouver. Negotiating these corridors isn't just a good idea, it's a necessity if Canada wants to diversify away from US infrastructure. The CPTP gives Canada tariff advantages over the US on thousands of product categories, but most businesses aren't using them because the routes and logistics aren't there yet. Labor shortages threaten to bottleneck everything. The Windsor-Detroit Tunnel moves $100 billion in trade every year, but there aren't enough customs officers for 24/7 operations. Trucking firms are reporting long waits at the border because staffing hasn't kept up with the new volume. If goods can't move, the whole supply chain advantage evaporates. Regional competitors aren't waiting around. Vietnam is attracting billions in new factory investments. Mexico's exports to the US are surging as approvals move faster. The US tariffs exposed a weakness, but Canada's slow response could waste the chance. The next chapter depends on whether Ottawa can turn policy into action, and whether Canadian logistics can keep pace with the world's new trade reality. Trump's tariffs created a $13 billion gap in US supply chains. Amazon's own import contract restructuring estimates make that clear. This isn't about luck, it's about logistics hubs filling up while US ports struggle, factories reopening as Chinese imports get priced out, and consumers in Canada benefiting from temporary price drops. Meanwhile, Vietnam and Mexico are moving quickly to secure new factories and trade routes. Canada's opportunity exists right now, not after months of debate. If policymakers want to capture this shift, they should prioritize fast-tracking digital customs clearance to keep goods moving, and avoid losing ground to competitors. Let me know in the comments, do you think Canada can move fast enough to take the lead? Hit subscribe, this story is changing.